IGCSE Economics forms Crazy IGCSE. Welcome back to Crazy IGCSE. For those of you who are new to my channel, hi, this is Crazy IGCSE, where you can study 7 IGCSE subjects at one place. The subjects include biology, physics, business, economics, accounting, maths, ESL, paper structures, solved past papers, and also paper tips. So here is IGCSE at your fingertips. Please subscribe and like. So classification of forms. There are three types of classifications. First is primary. So the primary sector includes the economic activity which involves the extractions of the raw materials from earth. So this will include agriculture, mining, fishing, etc. In pre-modern times, most economic activity and employment was mainly in the primary sector, and most of it was in the form of subsistence farming, which means farming for self-consumption. Second was secondary. So secondary sector, all economic activity dealing with producing finished goods. This includes construction, manufacturing, utilities, etc. So this is basically making use of the raw materials from the primary sector to produce goods in the secondary sector. And this sector gained importance during the Industrial Revolution and still makes up a huge part of the modern economy. Then tertiary, all economic activity offering the intangible goods and services to consumers. This will include retail, leisure, transport, IT services, banking, communication. This sector is now the fastest growing sector as consumers' demand for services have increased in developed and developing nations. So intangible basically means something which you cannot touch. Then public sector, this includes all firms which are owned and run by the government, and usually that will be the defense, arms, and nuclear industries of an economy, and they're all completely public. So public companies, firms, they don't have a profit motive, and their main aim is to provide services to the economy, and they also run some public schools, public hospitals, postal services, electricity firms. Private is this includes which all the firms which are owned and run by private individuals, and private firms, their main aim is to make profit. So their products are those that are highly demanded in the economy. And firms can also be classified according to their size, uh, whether it is small, medium, or large. So it will depend on the size of output, market share, organization, number of departments, subsidiaries. Then small firms. So a small firm is an independently owned and operated enterprise that is limited in size and revenue depends on the industry. They require less capital, less workforce, and less or no machinery. These businesses will operate on a small scale, and that will be to serve the local community and to provide profits to the owners. Now, the advantages include they have their own independence, so they are free to run the business as they want. They can do whatever they want. And second is control. So the owner has full control over the business. It will be their decisions which will be made, and there will not be any multiple managers, departments, branches because they will be their own owner. Flexibility. So small businesses will adapt to quick changes as the owner is more involved in the decision making. So there'll be less time taken in decision making. Better communication. There will be few employees, so the information can be um, passed on easily and quickly. Innovation. Small businesses have the capability of being innovative as they have less to lose and they're willing to take the risks. The disadvantage will include higher costs. So small firms will not be able to benefit from economies of scale as their average costs will be higher than the larger rivals. Lack of finance, they will struggle to raise finance like bank loan, bank overdraft as the finance will be limited. Then third is difficult to attract experienced employees. A small business may be unable to afford the wage and training which will be required for a highly skilled worker. Vulnerability. So when economic conditions change, it is harder for small businesses to survive as they lack resources. Then why do firms remain small? That is mainly one, there are many reasons. One of the reasons is size of the market. So if there is a small market for a product, the firm will not see a point in growing to a larger size as the market may be small due to the market is local. So here the example is a local hairdresser. They can't grow into a large firm as the market for that product or service is really small. Then the final product may be an expensive luxury and that will require small scale production. So here example is custom made paintings. Personalized custom services can be only given by small firms. So large firms will mostly give standardized services, so wedding cake makers. Then access to capital is limited. So owners cannot grow the firm. Owners preference to stay small. So many times the owner may not want much of stress and risks. So they will want to keep their firm small and they will be satisfied with running that small business. Then small firms can cooperate. So cooperate between the small firms can lead to set up jointly owned enterprises which will let them enjoy many of the benefits that large firms can also have. Governments help small firms. So governments do give them training for employees. They basically give them subsidies as they want more firms to increase in the country to increase the national output and the economic growth as well as to increase the employment. Internal growth. This involves expanding the scale of production from the firm's existing operations itself, and this can be done through purchasing machinery, opening more branches, selling new products, expanding business premises, employing more workers, and lots more. External growth is when two firms or more join together to form a larger business, and this will be known as integration. So, this can be done through mergers or takeovers. So, a takeover happens when a company buys shares of another company and then they can take full control. The firm taken over losses the firm taken over will lose its identity and become part of that holding company. A well-known example would be Facebook's acquisition of WhatsApp in 2014. A merger occurs when the owner of two or more companies agree to join together to form a firm. So here you see there is a difference between a takeover and a merger. Takeover is buying the shares and merger is agreeing to join together to form a complete firm. So horizontal integration is when firms in the same level of production join together. So it could be a cloth manufacturing company merges with another cloth manufacturing company. So it is in the same type of level of production. The advantages of this is that it'll exploit internal economies of scale, so they will be able to do bulk buying, technical economies, financial economies, they will benefit from this. They will also save costs as there will already be a lot of assets, including the employees that can be laid off. So uh, potential to secure the revenue synergies by creating and selling a wider range of products. So now since both are different firms, they will have different ideas for the products. So that way there will be a large variety of products which will be produced and sold. It will reduce competition. So two firms together will increase market share, unlike for example if it is firm A, firm B, They both will have competition if they are separate. But if they both become one, there won't be any competition. Or if there are many more competitions, it'll be at least lesser. So reduced flexibility, and this is the addition of more employees and processes, meaning that there will be need for more transparency and therefore it will be more accountable, and that will slow down the rate of innovating and producing new products and processes. Vertical integration. So, this is the integration of firms which engage in the production of the same type of good but at different levels of production. So, example, a cloth manufacturing company, which is in the secondary sector, will merge with a cotton growing firm, which is in a primary sector. So, you see, it is in different level of production. There is primary, secondary, and tertiary. So, there are different um, levels of production which can be uh, used. Then there are two types of vertical integration. Forward vertical integration is when a firm will integrate with a firm that is at a next stage of production. So a dairy farm integrates with a cheese manufacturing company. So this is primary to secondary. So it's going further. Backward is when a firm will integrate at a stage of production which is before that. So if a chocolate retailer, which is in the tertiary sector, will integrate with a chocolate manufacturing company which is in a secondary sector, it is going backwards. That is called backward vertical integration. Then the advantages of this is that it can give a firm assured supplies or outlets for their products, since they will have a producer or they will have a retailer in hand. So like if a coffee brand will merge with a coffee plantation, the manufacturers will be assured that the supplies of the coffee beans from the plantation will be guaranteed. But if the coffee brand merges with a coffee shop chain, they would have a permanent outlet to sell their coffee from. So that's an advantage for the firms, as it will be much easier for them to have increased supplies or an outlet for selling their products. Similarly, one firm can prevent the other firm from supplying materials or selling products to competitors. So that will make the firm competitive, as they will not, the competitors will not get the materials of making the product. So the coffee brand can have the coffee plantation to only supply them their coffee beans, not the others. So the coffee brand will also have the coffee shop chain, which will only sell their coffee with their coffee powder. Now the profit margins of the merged firm can now be absorbed into the merging firm. The firms can increase their market share and become more competitive in the market. The disadvantage is that the risk of diseconomies of scale increases, so a larger business will bring a lot of managerial and operational issues again, which will again lead to increased costs. It will reduce flexibility. It is a difficult process because firms, when vertically integrated, they are entering into different stage of productions which they aren't familiar with because they haven't really worked in that sector. So it will be hard to adapt to that new type of a process, and this will also require the staff to be additionally trained and educated, and that will even lead to them losing their jobs, and it can be expensive for the firm as it will increase the training costs. Conglomerate merger. This occurs when firms produce different types of products. So this could be at the same or different stage of production, it does not matter, but the products will be different. So if a housing company will merge with a dairy firm, this will be called a conglomerate merger because they're both different products. Thus, the firm will produce a wide range of products which will help increase the diversification of the firm's operations. So here, now it is internal economies of scale. So internal economies of scale, first is purchasing economies. So purchasing economies is large firms can be able to buy raw materials and um, components in bulk form as the scale of production is large, and that will increase the chances of receiving price discounts from the supplier for the bulk purchases, which will reduce their purchasing costs for the firm. Marketing economies is basically that they're already a large firm, they might be well known already. So it won't be very hard to advertise the product or the service as they're already huge, and they will have less cost for advertising because people may already know about their business or they'll be aware about the business. That will reduce their marketing costs. Financial economies is that since they're a large firm, banks know that as well, that they'll be able to repay loans or give back the interest amount. So banks will be more willing to lend them money since they'll be more confident that they will have a collateral also to give, and they will also receive lower rates of interest as they are large. So that will also reduce their costs, and that will also allow them to increase finance efficiently. Then technical economies, so they will have enough capital to invest in good and modern technology or skilled workers and machinery. This will increase the efficiency, eliminate the waste, and reduce the costs for the firm. Then risk-bearing economies, so large firms with high output will be able to sell into different markets, and that might be also in abroad countries, and they're able to produce a variety of products which will increase the diversification in their production, and this will mean that the risks are spread over a wide range of products and even markets. So if a market or a product is not successful, then they will have other products and markets to continue their business, and thus their costs will be less and there will be less chance of them running out of business. External economies of scale. So, um, yeah, external economies of scale. So basically, external economies of scale is when the industry is benefiting from becoming large. Internal economies of scale is when a business or a firm is benefiting from becoming large. So if there's external economies of scale, there will be increased access to skilled workers. So large firms will be able to recruit workers trained by other firms. So example is when a new training institution for pilots and airline staff opens, all airline firms will be able to enjoy that economies of scale of having access to all the skilled workers. And that will increase their efficiency and productivity, which will cut costs. Ancillary firms, these are firms that supply and provide materials or services to larger firms. So an ancillary firm, such as a marketing firm, locates close to a company, the company will cut the costs by using their services more cheaply than other firms. Joint marketing benefits. When firms in the same industry locate close to each other, they may share an enhanced reputation and a customer base because their customer base will be wide. Shared infrastructure. Development in the infrastructure of an industry or the economy can benefit large firms, and that can be more roads and bridges by the government will cut the transport costs for firms, and a new power station will be able to provide cheaper electricity for the firms. Now, diseconomies of scale. First is loss of control. Since diseconomies of scale basically means as a firm grows, there will be some disadvantages as well. So, first is loss of control. People will not, the managers will not be able to control the business as there will be many employees, lot of output, lot of customers, and they may not be able to control the business or handle it. Communication problems as the business is large, there will be many employees, and it will be harder to pass information in the company as there will be many chain of command, and then poor management. That's also similar to loss of control because they will not be able to manage the business with so many employees. There will be a lot of problems created, and there'll be a lot of decision making. So it will be very managed really poorly, too much output, since there'll be less costs, that will encourage the business to increase the output. And if there is increased output, that can increase the inventory. And if the inventory is increased, it will increase the storage and insurance costs, which again increase their average costs. So this is the end of the video. Hope you found this video useful. Thank you for watching Crazy IGCSE, and don't forget to subscribe and like the video. Thank you.